All right, it's me again, and I'm still hungry. It, like I said, never goes away. Anyway, continuing on. Now that we know debits and credits, now that we know everything's a T account, there's just some additional nuances that we want to introduce to the system so that it makes, and not that it makes more sense, but it's just easier to keep track of stuff. Right? So we were saying, hey, we have these transactions. And then we were saying we would put these transactions into T accounts. Then we would add up all the ending balances of the T accounts and we would sort of send them to the accounting equation. We're going to refine that a little bit in the next video. Then from the accounting equation, we would create the financial statements. Okay, so I don't want to observe transactions and throw them straight to the T accounts, right? So if I just think about cash, I'm going to have all of these transactions that hit the cash account, that hit all accounts. And it's really hard for me to keep track of what specifically is adding and why we are adding things, right? So if I add 10,000 because I contribute some money to the business, I sell a project to a customer for 5,000, I contribute some more cash, I generate some more revenue from another customer. Like it gets really hard to remember what the original 10,000 related to. So rather than going straight from observing the transaction to putting things into the T accounts, while we are observing the transactions, we are now going to just throw something into this portion of the process. We're going to create what we call journal entries. And journal entries, it's just like a diary, right? And so the diary is going to allow us to keep track of things that take place during the period. And then once I have everything in the journal entries, then we can throw things to the T accounts. For instance, let's say that I contribute $30,000 of cash to the business. The way that I would record that in a journal entry is first I would include the date. And I could just say, hey, this was January 1st, 2025. And then I would say the two accounts that got affected were cash and common stock. Then I would say, okay, cash is an asset. And from the previous lecture, we know that if I want to increase an asset, I would increase it with the debit side of the account. So I would, in the description, I would just include cash. And then over in the debits and credits, I would say, 30,000. And then we said the other account that got affected was common stock. Common stock is a equity. It increases equity. And like we were saying, if I wanted to increase equity, I would do it with a credit. So I would credit common stock. Then when I was ready, I could create a bunch of T accounts. I could create one that is cash and I could put 30,000 in cash. Then I can create one that is capital or common stock and I could put common stock over there. And I could just continuously do this, right? So I'm just going to go through a bunch of transactions. And I personally think that this class is more about interpreting transactions and understanding what accounts get affected. That is what makes this class hard. The debits and credits, it is complex right now at the moment, but that's going to become second nature. The math is never going to be very difficult. It literally is observing transactions and getting those into the financial statements. Okay, so second transaction. Let's say we paid $2,500 in cash for some office supplies. I would think the journal entry would be the two accounts that got affected first are cash. Cash is an asset, and I'm using cash if I'm buying supplies. So I would credit cash by 2,500 because cash is an asset and typically it's a left side account. And so if I want to lower something on the left side of the accounting equation, I would lower it with the right side of the T account. And then supplies is an asset. And again, since assets are on the left side of the accounting equation, if I want to increase something on the left side of the accounting equation, I would do it with the left side of the T account. Transaction 3, actually, maybe we can just post these, right? So I can post another transaction to cash, 2,500, and then I can create a new account called supplies. Obviously, I can't spell, and I would put 2,500 there, right? Okay, how about next one? Actually, maybe I can do this so I don't have to keep rewriting. So the next transaction, we will purchase equipment with cash. Okay, the two accounts that are getting affected, equipment and cash. I'm acquiring equipment and giving up cash. Equipment is an asset, and therefore it's on the left-hand side of the accounting equation. If I want to increase something on the left-hand side of the accounting equation, I do it with the left side of the T account. So I would debit equipment for 2,600. And then I'm using cash. Cash is an asset. If I'm using something or if I'm decreasing something on the left side of the accounting equation, again, I'm decreasing it with the right side of that account. All right. How about we purchase $7,100 of supplies on account? So we're going to purchase supplies on account. The two accounts that are getting affected are supplies and accounts payable. I think we just established supplies as an asset and it's going up. So I'm going to list supplies first. I'm always going to list the debits first. Supplies, 7,100. And then accounts payable, that is a liability. And liabilities increase with the right side. Liabilities are on the right side of the accounting equation. Therefore, they typically have the right side of the T accounts. So accounts payable, 7,100. All right, next entry. Let's say that we provide consulting services for cash in the amount of 4,200. Two accounts that got affected. Cash is an asset. It's on the left-hand side of the accounting equation, and therefore I would debit cash 4,200. And then if I'm providing services, then the services is a equity, service revenue is an equity, and it has the effect of increasing equity. And we said that if we wanted to increase equity, we would increase equity with the right side of the account. So revenue would be credited 4,200. All right, next transaction. Let's say that we pay 100 cash for December rent, right? So we already resided in the space, and now we're going to pay $1,000 for rent. Two accounts that get affected. Rent expense, okay? Rent expense is an equity, and it has the effect, it has the effect of lowering equity. So I would debit rent expense by 1,000. And then I'm using cash. Cash is an asset. And if I want to lower an asset, I would do it with the right side of the account. And so I would credit cash 100. How about I pay employee salaries 700 and I pay with cash? think it's going to look just the same, really. So the two accounts that get affected, salaries expense, that is a equity, and it has the effect of lowering equity. So I would debit salary expense, and I think we said 700. And then we pay immediately. Cash is an asset. If I want to lower something on the left-hand side of the accounting equation, I would do it with the right side of the T account. Maybe another transaction. How about we provide consulting services for 1,600 and rents its facilities? So we're going to rent our facilities for 300. Man, I think we talked about this last week. The customers billed $1,900. Man. Okay, so we provide services and we rent our facility. I think we could treat this as three accounts getting affected. Okay. The first account is an asset. And so we're charging our clients two things. We're charging them for services that we performed and for renting our facility. And they're choosing not to pay us now. They will pay later. So the asset that gets affected is accounts receivable. And the total amount is 1,900. Of that, service revenue is 1,600. We performed services. Services revenue is an equity. Services revenue has the effect of increasing equity. And if I want to increase equity, I would do it with the right side. And then we rented the facilities to somebody, and they paid or agreed to pay us 300 for the use of that space. Facilities rental income is a equity. It has the effect of increasing equity. And if I want to increase equity, I would do it with the right side of the accounting equation. Sorry, man, so hungry. The right side of the T account. Okay, moving on. Let me just erase this. Waste your time. Okay. Okay, let's assume now that from that previous transaction, right? Remember the previous transaction, we just debited accounts receivable by 1,900. Let's assume that this customer pays us. The two accounts that get affected, if a customer pays us 1,900 that is owed, the first account is clearly cash, and cash is an asset. It's on the left-hand side of the accounting equation. Now, if I want to increase something on the left side, I do it with the left side of the account. So I would debit cash of 1,900, and then I'm gonna lower accounts receivable. Accounts receivable is an asset, and if I want to lower that asset, I would do it with the credit side of the T account. And now that customer doesn't owe me anything. Now we can assume that we owed somebody from a previous transaction. And so in our accounting system, we have an accounts payable, and that is a liability. And so we are showing that liability on the right side of the T account because accounts payable is on the right side of the accounting equation. So if I'm going to use cash to pay that down, the two accounts that get affected are accounts payable. Accounts payable is a liability, and if I want to lower a liability, I would do it with the left side of the T account. So I would debit accounts payable 900. And if I'm using cash, cash is an asset, and therefore that's a zero. Therefore, I would credit cash. Man, my writing is so sloppy. How about we pay cash dividends of $200? Two accounts that get affected. Dividends and cash. Dividends is an equity. However, it has the effect of lowering equity. So if I wanted to lower equity, I would debit dividends by 200. And then I'm paying dividends to my customers, sorry, to my owners, and therefore I'm using cash, and cash is an asset. I'm decreasing an asset. If I want to decrease an asset, I would do it with the right side of that T account. Okay, this is a hard one. So you definitely want to pay attention. And if you're watching this, like, more power to you, because this one's going to be hard. And having the benefit of this explanation may prove to clear up some confusion. So a customer is going to give me $3,000 in cash right now, and then we are going to perform services later. All right. So we are not actually delivering the service now. It's like a customer calls us up. We don't know who they are. They want some stuff done. And we say, hey, listen, you just need to pay in advance. You need to pay a retainer. So the customer pays a retainer. So cash is definitely a receipt. I'm definitely receiving cash. Cash is an asset. So I'm going to debit cash for 3,000. Now, what's the credit? A lot of you might be thinking it's service revenue, but it's not, because in order for something to be categorized as revenue, two things have to happen. We have to deliver the service, okay? We can't promise to deliver the service later. We have to deliver the service. And then the customer could either pay us now or pay us later. So in this example, we haven't done anything yet, so it can't be revenue. If we are obligated to do something for a customer and we've already received the cash, we call it unearned revenue. And unearned revenue is a liability. Look, we are obligated to do some work for this customer. An obligation is a liability. If I want to increase a liability, I would do it with a credit. So I put the chances of somebody actually watching this at like close to zero. If you are watching it, definitely shoot me an email. Um, but just a few more transactions. And how do you like the fact that I'm now pausing the recording and then erasing the screen so you don't have to sit through me erasing the screen? It's pretty advanced stuff. And deep into this semester, I'm going to be so good at these lectures. It's not even funny. I already feel way more comfortable. Um, and now I'm just going to have to figure out how to fold in my humor a little bit more, um, without wasting too much of your time. Okay, this particular example, we are going to pay 2,400 for a subscription that we will receive over the course of the next 24 months. So we are going to receive this benefit later. We're not receiving it now. And just like revenue can't be recognized unless we deliver the service, we also don't recognize an expense if we do not receive the benefit. Okay. And since we're paying for a subscription that's going to last over a 2-year period and we haven't gotten a single issue, there isn't any expense associated with this. All we are doing is we are trading one asset for another. So the account that's getting affected here, it's not insurance premium expense, it's prepaid insurance. We are saying, hey, we want insurance over the next 2 years, and we're going to cover that over the next 2 years. We haven't covered any of it yet, so therefore it's not an expense, it's an asset, and we call it a prepaid insurance asset or a prepaid expense. And then we obviously use the cash. So prepaid insurance is an asset. Assets are on the left side, therefore we increase it with the left side of the account. Cash is also an asset. We're decreasing cash. If I want to decrease an asset, I do it with the right side. How about I pay $120 for some supplies Two accounts that get affected. Supplies is one of them, and cash is the other. Supplies is an asset. If I want to increase an asset, I would do it with the left side of the T account. Cash is an asset. And if I want to use cash, man, we have to know by now that would be a credit to cash. All right. A utility bill comes in for $305. The two accounts that get affected are utility expense and cash. Utility expense, usually it's the assumption that you use your electricity or your telephone, but you're using the utility first, and then the utility comes out and measures how much you used, and then they therefore know the specific amount that they need to charge you. So usually it's the case that you use the utility first. And since you used it or received that benefit, it's an expense. So utility expense, $305. Utility expense is an equity. However, it lowers equity. And if I want to lower equity, which is on the right side of the accounting equation, I do it with the left side of an account. And then we're using cash. I'm not even going to explain it anymore. We credit cash for $305. Okay, last one. Man, you thought this would never end. Payment of cash expense of $700. So employee salary expense, and we're using cash. The two accounts that are getting affected, employee salary expense. Salaries expense is an equity that has the effect of lowering equity. And therefore, if I want to lower equity that's on the right side of the accounting equation, I would use the left side of that T account. So salary expense, 700. And then I'm using cash. And God, if I have to explain cash one more time, I might kill myself. Anyway, that is how we do journal entries. Obviously, I haven't been including the date, right? The date in addition to the description, right? Debits and credits. And we could also even have a little note here that says, hey, we just paid our employees on X date. And so then when we go over to put this information into our T accounts, right? We have everything that we would possibly want to understand this transaction. I would say, hey, you know what? The $700 transaction came from this page in the journal. Apparently, we debited salary expense and credited cash, and then there's an explanation that we paid employees for some particular period of time. Again, I pulled all of these examples straight from the PowerPoint slides of Chapter 2. So you could start along. I started the first transaction was on slide 24. So you could literally follow this lecture and flip through the PowerPoint slides at the same time if you wanted. PowerPoint slides are obviously much prettier than what I'm presenting to you. But we just did that last transaction, 16, and that's what 16 looks like. So theirs is sort of right there. I was like, hey, salary expense, 700, cash, 700. Theirs looks a little nicer than mine. But anyway, that is how we analyze transactions.